Hi, this is John from Bear Bull Traders, and I want to talk today about how I use stops in my trading, specifically as it applies to the high of day break strategy. But I think this applies to any momentum-based strategy. It's something that you could try to apply in your trading. And as always, if you could drop a like or hit the subscribe button, we really appreciate that. Let's get into this. All right, today I took a high day break trade on Peloton, and I saw a few good things here. Maybe not the best setup ever, but definitely some potential. Had a nice optimistic red to green move on Peloton. I do like stocks that start off in the red, move down into the red, and move back up into the green. They can make great moves and get some upside potential for the rest of the day. This had a decent high a day of 122.77, not because of that level in particular. It'd be cooler if it was near 123, but it is near the R3 Camarilla pivot at 122.69, and it looked like we got some rejection off of that pivot point to take us back down around the previous close. And you can see this level held. This is the previous close, this is the black dotted line. Also have the pre-market high here, this dotted magenta line. So the double level there might have been what provided some support, that general area for Peloton as it started to make a move back up higher. And one thing I noticed was just this bit of building volume here. Not all on white candles, as you can see, but there is potentially some building interest here in Peloton as it holds this support. So I kept watching it, and then I could see the high day break fully forming. So I was nervous to take this too close to R3. What I don't want to do is catch another rejection, because R3 can be a big rejection level, whereas R4 can also be, but is more of a breakout level. So I wanted to see a clear break of R3. So it seemed like the better case might be to play this on the break of 123. See if a decent sized ask sets up there and then take the break there. And this set up very quickly. So we had this surging volume come in. Remember, we had this building volume, and then it started the surge. Had to make a quick decision about whether I like this or not. So it does look a bit extended here, but with this amount of volume, this is almost as much as any other bar except for the open for the whole day. So there is definitely some potential for a move here. What I ended up doing was taking an entry at 123 exactly. And this is a good entry because there was a bit of an ask on the L1. So often what you see is that big ask kind of hit the level 1, gets bought up a bit, and if you can get a piece of it as it's getting bought up, you can get a move upward. Now, what I want to talk about today is where I set my stop. So my full 1R stop is down at 122. It's $1 below 123, my entry, because I took 100 shares of Peloton and I'm risking $100 on this trade. So if I fail and it falls from 123 to 122, that's a $1 move times the 100 shares I took, and I'd lose that $100. So that's my full 1R, but that's what I call a fail-safe stop. And the reason I have that there is because high days are contentious levels, and it can be a place where it pulls back strongly. So I'm hoping not to see that happen. What I'd rather have is take the entry and be able to make a decision about whether I want to stay in or not. This is to save me for the full 1R loss. And you can see here, Peloton almost made a full move in one candle from 122 to 123. So the potential is there to pull back as much in a single candle, which could put me in a indecisive spot where I get out near a 1R loss. When I have this kind of building volume, though, that tends not to happen. And I don't take a lot of 1R losses. I take them about 10% of the time. The other 90%, it's something less, and usually a lot less. So I did see this nice building volume continue. So we had that surging volume as it approached 123. After I got in, that volume continued, which is a good sign. But at this point, my decision to bail out or stay in is really a function of volume, time, the market, etc. So volume looks good because it's continuing to build, it's continuing to surge. Time is fine because here I'm still on my entry candle, so hardly much time has elapsed at all. And then there's other lesser factors like what the SPY is doing, what the overall market is doing. Well, let's watch how this played out a bit more. So let's think about what I expect to happen. I want to think about time here as a decision to bail on the trade. So a high day break trade is a momentum play, at least initially. Now, if you get into one, what you're hoping is for some momentum on the break, and then you get your stop to break even, you can play it out from there. I've been in high day break trades that end up lasting for hours. They're certainly not momentum trades, an hour or even 10 minutes or 6 minutes after you enter it. The momentum's gone, but the upward upward price movement can still exist. But what I'm trying to say is the break should happen quickly. And quickly depends on the time of day. So I say generally 1 to 5 minutes, but it's more like 1 minute closer to the open and more like 5 minutes in the afternoon. So here we are at about 9:50, 9:51. We're maybe 20 minutes after the open. So I really want to see this work out either in the next candle or maybe the one after that, 1 to 2 minutes after my entry. And then I probably don't want to be in this trade anymore because the pattern should look like what I expected. I should expect a pattern that kind of looks like this. Here we have the upward movement, hits the high of day, pulls back, finds support, gets moving again. Here's my entry, and not long after my entry, I should see the breakout. That's what I would expect. I don't want to see it way over here because that's not my strategy. If I wait that long, I'm into the area of hope and not, high probability strategy. So let's look at how it all played out in the end. The volume kept building after my entry. So here's my entry volume. And it did test on R3. I was watching that very carefully. So that had me down to about 0.3 R, not loss, but, unrealized gain of negative 0.3 R here. And then the volume kept coming. I kept watching that very carefully, and I really liked what I saw. And Peloton started to make its move. And it did print a sale up at 123.43. That's up here. But was too small of a move for a partial, but kind of too big for me to stay in at the same time. It's kind of that in-between move. And the bid, a sale happened at 123.43, but the bid never really got much above. I want to say 123.20s, somewhere in there. The spread was a bit big on Peloton, which is something I should have been considering. So kind of in this funny zone. Can't take a partial. It's too early to move my stop to break even because I wanted to see the bid go higher before I do that. I wanted to see the price move away from my entry on the bid. So I waited it out a little bit, and because time is a function of my decision making here, I saw it pull back down to R3 again, and I decided to get out with a 0.3 R loss. It was taking too long. That's the issue here. I could have waited to see if R3 would hold. That is an option. And you can see if I did that, I would have stayed in the trade a bit longer. But this isn't my trade anymore, and that's my point. So if I stayed in past where I got out, I've left the high probability punch out momentum that I'm expecting. Remember that pattern that I expect to happen, and now I'm into the unexpected. It could move higher, but now I'm just getting lucky if that happens. So what I expected to happen no longer exists, and it's time to get out of this trade because this is not the pattern I want. So something to impress upon you, you should have an idea of what your pattern looks like as well when you take a trade. It could be a reversal, it could be a momentum trade, like a high day break trade, but you should have an idea of what you expected to happen pattern-wise, and that's not the case here. So I'm completely happy bailing out with this small loss as a function of time and not as a function of my full 1R loss. So that's why in the aggregate, over many trades, my average loss is not negative 1R, which it would be if I always held for a 1R loss on a loser. It would be a 1R loss with no variance whatsoever. But instead, my average loss is like, I want to say 0.55 R. So that is actually one of the things that keeps this strategy in the positive over many trades, is that I often bail as a function of time or volume or some other market feature, as opposed to just taking the full 1R loss. So I hope this makes sense. If you want, drop me a comment down below and we can talk about it. And I'll talk to you guys next time. Bye-bye.